Oh, hi traders. I hope you're all well and looking after yourself. Just looking at this market and looking at the equity indices, and I'm not actually convinced that this market is going to stay up where it is at the moment. In my mind, it is risk off, and there's a couple of reasons for that I have to say. Even though the Dow and the S&P have been up, and they're still up, the Dow's up over 24,000, I tend to think this is a selling area. That's my personal view. I'm not giving you financial advice, but that's certainly what I'm doing. And there's a couple of reasons for that. When I look at the other indices, which are much more broad-based, like the Russell 2000, for example, it's in negative territory. Also, the VIX indice, which is the volatility measure, Chicago Board of Exchange, that measure has come down a lot from 80 and it's currently at 40. And I tend to think I'd be buying the VIX again. It's come down from 80 or 82 at its extreme that we've seen in the last lot of, the last couple of weeks. And in my mind, that's a buy here. But what makes me more convinced is other broader base indices are looking quite weak. Don't forget the Dow's got about 31 stocks in it, and the S&P has got about 502. It's not quite 500. And also these are weighted indices according to the market cap. So you can have, a market cap in there, say Netflix or something quite large that's doing quite well when they had more and more subscribers because of this COVID virus. So I'm not particularly convinced this equity market is going to continue to rally. Apart from that, also interest rates are going up and credit spreads are starting to blow out, and we'll have a look at that as well. And that's why I'm not a believer that this market, the equity market particularly, is going to continue to rise. Okay, so if we look at basically the materials indices, they're down negative 0.28, real estate 0.22, industrials 0.54, financials minus 0.38, and energy is down as well. We've got specific things that are going up like healthcare, technology, consumer discretionary, staples, and that sort of thing. But again, in saying that, as I said, when we look at other markets and broader base indices, the more riskier type indices, they are all off. And if we have a look at these indices, Mexico's down, the composite from Toronto's down, emerging market debts indices are down, like Brazil, for example, Hang Seng, Taiwan, even the Australian indices down, and other industries, the CAC, which is the French market, the Italian market is down. That doesn't surprise me. Italy's got massive debt and it may not be able to pay out that debt. Don't forget that. It's the third largest bond market in the world. And also Italian interest rates are going up. Sovereign Italian interest rates are going up. Now, if sovereign Italian interest rates go up, that's the government interest rates. It means that every corporate in Italy, all their funding is also going to go up. Their corporate debt funding is going to go up, okay? So we're even seeing it in other markets like Tel Aviv as well. So again, I'm not that convinced. If we look at the ETFs, and again, ETFs are another story. We have had ETFs, coming back a little bit, but overall they're still negative. And again, what's making me even more convinced is Mexico, Canada, Colombia, Chile, Brazil, all the ETFs are down, Hong Kong, Japan, Indonesia, Sweden, Germany, Italy, France, Portugal, Finland, and whatever. So if this was a broad-based bullish equity market, the ETFs overall would be doing really well as well. So again, I'm not convinced that this equity market is sustainable here above 24,000 on the Dow. In my mind, I'm a seller, as I said, and when you look at the broader indices, it's actually showing that, okay, and it's very, very specific. So if we go just have a look at, again, some of the other factor type models, if you have a look at high dividend yields, they're down, negative value models are down, small caps are down, which has got a high beta than, say, the Dow index, because small caps are a lot more volatile, as you can appreciate. Again, if we look at IPOs, buybacks, spin-offs, large caps are up, but mid to small caps are all down. Large cap value are down, negative. Small caps and mid cap and small cap value are all negative, okay? So as I said, if we had a broader base, if the market's very, very bullish, all these indices are going to be doing pretty well, okay? So if we go to global yields, and this is very telling in my mind because interest rates will affect the valuation of equity markets, okay? Now, we have seen Australia down, 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 but, we've seen a steepening of the yield curve. Now, if we go to something like France, yields are actually going up. Germany, yields are going up, which is not great for equity markets, okay? Greece, yields are going up. Again, India, we've got the long bonds going up compared to the short, steepening of the yield curve. Indonesia, steepening of the yield curve, okay? Italy, we're seeing long bonds go up a lot, and we're seeing a massive steepening of the yield curve. And Italian rates have been moving quite substantially, okay, in the last week particularly. We're even seeing it in Japan. Japanese interest rates were negative and incredibly low. They were below zero. And, we're seeing it in, the 7-year and the 30-year at 13 basis points up in 19. When you look at an extremely low base like Japan for interest rates, and it's a negative interest rate, a bond move in pips of 19 pips is a huge move in terms of rate of return. Absolutely huge, okay? So I say buyer beware in the equity market, because the equity market, its valuation gets reduced as interest rates go up, okay? It's very clear. It's that easy. It's that clear. If interest rates start rising, the valuation in the equity market starts coming down, okay? Even if we look at, say, Kenya, Lithuania, Malaysia, rates are rising. No matter what anyone tells you, rates are starting to rise. Netherlands rates are up. Yes, we see some down, but overall interest rates are rising. And the reason for that, as I've said before, there is inflation in the system. Anyone that says there's not is just, dreaming. Seriously, the cost of living in the last 20 years has gone up astronomical, and there is no way inflation can be running at, 1.5% to 2% per annum. It is just not true. Food prices are up, in the last year or so, and I've mentioned this before, 36-40%. Utilities, every time I look at a utility bill, it's going up 5%. Gas, electricity, water. Seriously, interest rates are rising because there is real inflation in the system. Also, there's a lack of liquidity in the system, in the financial market, money market system. So if there's a lack of supply of money, right, and the cost of money is an interest rate, then interest rates need to go up. The cost of money needs to go up. It's that simple if there's a lack of supply. No different to if there's a lack of supply of apples, the cost of a price of an apple would go up, okay? It's that simple. If you look at Portugal rates, they're rising very substantially. That doesn't surprise me because Portugal's like Spain. Got a lot of problems, hardly any growth. Growth's negative. Unemployment's high. The figures in Spain for unemployment are probably more like 30% unemployment, particularly amongst youth unemployment. Portugal, a lot of people go to the Netherlands and Amsterdam to work because they cannot get work in Portugal. Okay, even cleaners cannot get work in Portugal, right? I know that because I was living in Amsterdam for, a good 6 months or so. So Portugal interest rates are going up quite substantially, and that tells you something. For the sovereign government of Portugal to borrow money from the bond market for a sovereign bond from the Portuguese government, it's going to cost them more to borrow money from the bond market. And we see this. There's a squeeze on here. It's costing more for 1 year money, 3 year money, because it's actually gone up quite a lot in terms of, the spread. But rates are rising overall, okay? We've got a flattening the yield curve here, but rates in Portugal are rising, okay? And, that tells you something. That tells you something about what's going to happen to markets, okay? Even Romania rates are rising, right? Russia, yes, they're down, but again, it's still a part of emerging market debt. How long will they stay down for when every other country's emerging market debt is rising? And we see that in South Africa as well. Rates are rising. So, the very weak countries in the Euro Union, like Spain, Portugal, what else we got? Spain, Portugal, Italy, rates are rising. Here we go again. Look at Spain. Rates are up, 50 basis points, which is a big move, 48 basis points for the 3 year. 1 year is 34 and 10 year is 20. So when I look at where I believe equity markets going to go, I look at these rates, okay? All, the solid economies, rates are tending to go down, the US and that sort of thing, but I really believe interest rates are not sustainable at this level. There is just no way known, okay? It's a false interest rate curve. It's not reflecting the reality of economic activity or the inflation rate. That's in my mind, okay? So that's something you need to really keep a look at. If we go to corporate debt spreads, and that's another thing I look at quite a lot, okay? Corporate debt spreads are blowing out, and they have been blowing out. And we saw it last night, particularly in triple C. Corporate spreads were blowing out. If you have a look here, triple C's, certainly over the month, corporate debt spreads have blown out, and you see it here all along there. And certainly, if you look at the emerging market corporate debt spreads, they're all blowing out. Now, if the market was bullish, and don't forget, if the market was bullish equities, then you should see the market also bullish high yield corporate debt, but it's actually not. Okay, there's generally a positive correlation between equity markets globally and emerging market equity markets and emerging market corporate debt. Now, I tend to think the bond market is correct and not the equity market, because the equity market is full of more retail traders, whereas the bond market and the corporate debt market is full more of professional traders. So in my mind, emerging market debt spreads are rising. Credit default swaps are rising for countries like Italy, Portugal and Spain, where there's a real risk that they may not be able to pay their debt, which means they would default. And if they default, they're going to have Buckley's getting money out of the capital markets, okay? And that's a fact. So, while we've got this situation, buyer beware of the equity market, okay? If we look at some of these here, again, spreads are moving, then they're moving higher, okay? Very much so, very much so. So, that's a scary thing. So keep an eye on that, because it's not going to change. In my mind, the equity market from here is a sell, and in my mind it is risk off. This is my own personal opinion. It's not financial advice, as I said. Another thing that makes me think that as well is the Aussie dollar. Now, the Aussie dollar is always considered, a speculative currency. It's one of the 5th largest trading currency pairs in the world against US dollars, and it has been coming off quite a bit because it's got a lot of exposure to China, and obviously Chinese GDP was quite negative. It came down quite a lot. Another thing also that makes me think that is we've had yen strength, okay? Even though, albeit the US dollar has been holding up nicely against the yen, we're starting to see yen strength. And when we see yen strength, that tells us that people are going into safe haven of buying yen, okay? And another thing what they do is they buy the safe haven of yen, and they'll also buy things like Norwegian krona or the Swiss franc and things like that, okay? And every other emerging market debt currency will get sold off. And that's pretty much what we're seeing here, right? US against Malaysia, Russian ruble, Colombian peso, Ukrainian, whatever it is. These are all emerging market debt currencies, right? And they're being sold off as well, okay? So I just say be very cautious, because this market, this equity market, for me, anything over 24,000, and my model is basically telling me this is a sell. Be careful, because everything else is telling me that as well, okay? If we go to commodities, and again, another thing I look at, and I look at a lot of different things to give me an idea of markets, okay, to where I think they're going to go, right? Another thing that's been very negative, and as traders we've always looked at this, right, is the Baltic Dry Index and the Commodity Research Bureau Index. Now, this Baltic Dry Index is a shipping index, and it tells you how many ships have been going around the world dropping off goods, okay? And it gives you an idea of economic growth around the world, right? If you look at this, year to date, it's down 33%, 3 months down 5%. Yes, it may have gone up in the last month, But the overall, it basically means that shipping is down 33% year to date, okay, to April, which is a massive move down, okay, massive move down, which means economic growth is not being established. It's actually getting weaker and weaker. Also, the Commodity Research Bureau Index, which houses in that index, it's a weighted average of soft commodities as well as hard commodities. You know, it could be metals, it could be agriculture, whatever. You know, that is also down 33% year on year. And again, that's telling you that there's no consumption, you know, of hard commodities or soft commodities, and it's not a great story. You know, we're seeing with the London Metal Exchange Index as well, down 16%. You know, the S&P GSI Index is down 42%. You know, all these are down substantially, okay? And again, this is all to do with consumer demand. And if consumer demand is down, you know that the GDP of the economy, the gross domestic product of the economy, is going to be quite negative and down. Now, you know, a US equity cannot, you know, stand alone by itself. You know, if the overall growth, the macro growth of an economy is quite negative, you know, eventually it's got to start feeding into the retail, into the revenue, I should say, of that corporate, right? Very, very clearly. The revenue of the corporate has to start reducing because every other macro figure is telling you that, okay? So that's my view, and that's pretty much what I look at, right? All the other macro picture is quite negative, that's for sure. So in my view, this is pretty much a relief rally in the Dow. And again, as I said, it's only 31 stocks, and it is a weighted, a weighting of, depending on the market value of that stock. The bigger the market value of a particular stock that goes into the Dow will have a higher weighting, okay? But it's not showing you the true figure. So in my mind, I put out something the other night. I'm short the Aussie US, which I am. I'm short Aussie yen, which I am. You know, I'm short the US indices, which I am. I still think gold is a good buy. You know, if gold gets down to about 1680, I do believe there's inflation in the system. You know, I would be buying gold. That's my view. But I'm very, you know, worried about interest rates, particularly in the US. I think interest rates can actually rise because they are way too low. Corporate spreads are blowing and credit default swaps are blowing as well. So anyway, traders, please be careful. Please click the subscribe button and the bell for when I come out with some more stuff in terms of YouTube. And I look forward to talking to you very soon. And please do trade safe because we're going to see more and more volatility out there. Thank you.